Hello, beautiful people, and welcome to another brand new edition of the ITU Forex class. In this week's episode, we're actually going to be talking about volatility and trading during times when the volatility is at its highest within the Forex market. Okay, so I know if you guys are kind of new to trading, you might maybe not have heard about this term, or maybe you've heard about it, but it hasn't been really explained to you in a way that you'd understand what it is and how it affects you. And that's exactly what we're going to be covering in today's class. Okay. So first things first, before we go into the high level theory behind volatility and all of that, what is volatility? What does it actually mean? Now, to help you understand what volatility means, we need to come back down to the basics. Okay. Forex trading in its purest sense. Okay. Not only Forex trading, any trading which involves trading any financial asset which is charted just like the ones you're seeing here, for you to actually make money through trading, you actually need to buy an instrument at a price which is lower than the price you're going to sell it at in the future to cover your profits. Okay, so in simple terms, let's assume that this is an instrument that you're trading. This is the chart of the Euro USD. Okay, so let's assume that you wanted to make profits from this trade. For you to be able to make money from this trade, you need to buy it when it's cheap. So let's say ignore all of this price action we have to this side, or to make it easy for you to even see, let me shift the price action away. Okay, so assuming all of that price action didn't happen, and let's say price was somewhere around here. Okay, and you decided you wanted to buy after your analysis, of course, and whatever the case might be. Let me quickly turn this off so that it doesn't auto shift. So let's assume that you did your analysis and you saw for whatever reason that, okay, since price broke above this resistance, you are of the opinion that based on your analysis, price is going to continue moving up. And so you bought when price was somewhere around here with a stop loss placed somewhere below this price level. Okay, and so for you to make money from this trade, price needs to actually move higher than the price where you got into the market at. Because if you bought when price was around this price area and your stop loss was around here, if price goes higher than the price you entered in, then you're going to make profits. But if price goes lower than the price where you entered your long trading position at, then it's actually going to be a losing trade. And depending on how far that losing trade, that price moves, then it's either going to hit your stop loss or it's either going to give you, a very big loss that you're not going to recover from if you don't do proper risk management. Okay, all this to say that volatility is a function of price movement. Okay, so when you have price movement that is very, very strong, very, very aggressive, that is considered as a very volatile market. Just like we had price action move from this price area, which was around 1.1710 or so. Let's just say 1.1700 on the Euro USD chart. And then it went all the way up to 1.18. This is like a 100 and something pips move. So this was a very volatile period within the market. Now contrast this to this period on the chart. You see, within this period, we've had a couple of hours go by, but the price for the Euro USD currency pair was just bouncing off of this price level. Okay, so it barely moved, let's say from the top to its bottom, it barely moved around 20 pips for the past around, for the past 12 or 13 hours. Okay, but when you contrast it to this price movement, where price broke out from this resistance and then it moved very sharply to around 100 and something pips within just, let's say, 16 hours. Because the reason why I'm saying 16 hours is because this is the 1 hour chart and it took around 16 bars for this to happen. So you could say it's safe to say that the volatility when price in the market, when price formed this price action, was very low because there were no violent moves in price action like we had sudden moves here. Okay, so during this period the volatility was high. So now that you understand what volatility is, why is it important? What does it even, now that you understand what it means in the market, okay, and you need volatility in the market to make money, okay, that's the reason why volatility is important, okay? So in essence, the reason why volatility is important is because as a trader, when you buy a currency pair or you sell a currency pair, if it doesn't move, you're not going to make money from that trade. Likewise, you're not going to lose any money from that trade, assuming you're not paying for swaps and all of that. Okay, I'm trying to keep things very simple here. Okay, just to understand the basic mechanics of volatility. Okay, so assuming you buy or sell a currency pair and it doesn't move, and let's say you're trading on a swap free account, so there are no swaps, and you hold that position for months on end. If it doesn't move, you won't make any money. And so that's the reason why volatility is important, because volatility is just the movement that we have, okay, of the currency or whatever price movement we have in the market. That's what volatility is. If we have a very strong move, okay, whether it be in favor of your trade or against your trade, whichever side the price moves, that's volatility. And so we need volatility to be able to make money through trading. And that's why it's very important. This is much more important. In fact, it's more important. It's not like it's not important for the other group of traders, okay? But it's much more important for day traders, okay? Because for a swing trader, most of the times, even if his trade, takes a couple of days to materialize, to hit his stop loss or its profit target, it doesn't really bother him that much, because, his trading style is usually low maintenance. But for a day trader, you actually need price to move very well within a given trading day for you to make money through trading, okay? And because of that, this now takes us to one of the things that is important with volatility. You need to understand that when we are trading the forex market, in particular the forex market, the forex market is made up of a couple of sessions, okay? There's the Sydney session, which is for markets in the Australia region and all of that. Then right after the Sydney session, we have the Asian session, which includes markets like the Tokyo session and all of that. Then we have the London session, or the Frankfurt, which is the European session, basically, okay? And then we have the New York session. Now, these are trading sessions where it's just like, let me give you an example with, assuming in your country where you're living right now, okay? Most of the times, when it's night, the amount of activities you're going to be having in the market, forget the trading markets here, I'm just talking about the physical markets that you go to physically and buy things, okay? Usually at night, the activities that is going to be going around in those markets is going to be a little lower than during the daytime, because it's only the norm for humans that at night we sleep, we rest. And during the day, we hustle and bustle and grind and all of that, okay? So this is almost the same thing with trading. During the night, most of those banks and central institutions which are involved in the markets, trading in the markets, they are usually closed. Okay? They're usually closed. So in London, it is not uncommon for Saturdays and Sundays to have all of those huge financial institutions, the banks and all of that, to be closed. And so even on Mondays through Fridays that they are open, usually that time when the activity are going to be much more is going to be from the early hours of the morning when they open and they operate to the late evenings when they are closed. But then when it's midnight and all of that, the workers obviously need to go home and have a rest and whatever. So usually trading activities are going to be at their peaks when these particular sessions, the workers in those sessions are active and they're at their desks. Okay, that's all I'm trying to say here. Okay, so let's assume that London starts trading around 8 o'clock in the morning, and then it stops. Maybe, they close the traders who trade close around 5 in the evening. Most of the times, the heightened volume of volatility that you're going to see during the London session is going to be from that morning to the evening. The same thing could be said for the New York session. Most of the times, the bulk of those movements in the market, the bulk of the volatility is going to be from the morning when the traders step into their offices to the evening where they close shop. Okay? Now, these influence how volatility is seen in the markets. And because the world is kind of a globe, and when it's nighttime here, most times it's going to be either morning or whatever the case might be in other regions of the world, there are times when you'd have 2 or more sessions overlap. And when those 2 sessions overlap, that's when you'd see most of the movement in a currency, okay? All this to say, when you use an indicator like the one you're seeing on my chart here, which shows you when these sessions occur, when these sessions are active, you're usually going to see much more activity when 2 or more sessions are active. So let me show you with a couple of examples here, okay? you can see that this is a chart which is showing you a couple of trading sessions. Okay, so whenever you see a period separator starting from here and ending here, this price action you're seeing within this period separator is showing you the price action which occurred during one single trading day. Now, I want you to pay close attention to what you see here. When it's the Tokyo session, most of the times it's usually night time. When it's Tokyo session, it's around midnight in areas like the United Kingdom, and New York is late in the night and all of that. Okay, so the session is predominantly going to be Asian session, and most of the times the volatility is going to be lower compared to when London and New York are both open. So when you compare this, you can see that we had this price action from the high of this session to the low of this session was around 59 pips. But then when you take a close look at what happened next, you can see that when London session came in place, and then New York session came in later on, when both of these sessions came into place, we had a price movement which almost doubled what we had during the Tokyo session. And this is because two of these sessions were overlapping at the same time, and so the volatility in the market was much more. So the reason why this is more important for day traders is because when you're a day trader, remember, I told you that if you are trading, whatever the case might be, whether you're buying or you're selling, if there's no volatility at all in the market, then you're neither going to make money or lose money, because price is not going to move either in favor of your trade or against it. Okay, and so this is the reason why you need volatility. So for a day trader, it's only going to make sense for you to get into the market with a trading position at the moment where price is much more likely to move. Moving, whether it be against you or in your direction, it doesn't really matter. You just need that movement, because if price needs to hit your profit target, you either want it to happen very fast before the end of the trading day, or if it's going to hit your stop loss, again, you could appreciate it doing that very fast. Okay, so assuming you were a trader who is day trading and you're only trading during the the Tokyo session, and you go into a trade here, imagine how many hours you'd have to have sit to wait for a price to either move in favor of your trading position or against it. Compare that now to when you had the price movement during the London and New York session overlap. And when that happened, you could see how fast price moved. Within a couple of hours, it moved over hundreds of pips. Okay, and so this is one of the reasons why understanding how volatility works in the market is quite important. It's very crucial. Okay, so you need to understand when you're going to get possibly the most moves in the market, so that you can capitalize on that. Okay, usually because of this, breakouts are much more likely to happen during those time periods when there is increased volatility in the market. Okay, so if you're a breakout trader, you're usually going to see more of those breakouts when there's increased volatility in the market. But having said that, just like anything in trading, there are pros and cons to this. Okay, and the reason why I say that, what I mean by there are pros and cons to this, is that when there's increased volatility, most of the times it might be because of geopolitical, factors like news events or all of those kind of things that cause movements, sudden spikes in the market, which usually lead to very strong movement in price. Now, what are the downsides of this? The downsides is when you have a sudden movement in the market, when there's a sudden increase in volatility, usually that comes with the negative effects of things like increased spreads, widening spreads. If usually on a normal day, maybe the spread on the Euro USD currency pair was like how many, let's say 0 pips, or just say 1 or 2 pips. Okay, and maybe your broker just charges commissions or whatnot. When there's a sudden spike in volatility in the market, you're usually going to see spreads upwards of 10 or even 15 pips, depending on the slippage that you're going to see. And so if you're a day trader who trades, or scalper who trades with very large position sizes, because you're just in and out of the markets with a very quick profit, or whatever the case might be, those spikes in or widening in spreads, okay, due to the price action, the increased volatility in price, is usually going to make it your cost for your trading positions increase significantly. If you remember from a couple of classes that we talked about in the past, where I gave you the example of the advantages and disadvantages of scalping and whatnot, you can remember that for a swing trader, because your stop losses are usually going to be, quite a reasonable distance away from your trade entry level, your position sizes tend to be smaller than that of a scalper or a day trader. Now, the downside with that is that if you're trading with a scalping or a day trading mindset, because your position sizes are relatively bigger, you're going to feel those widening spreads much more. Price might even hit your stop loss without actually reaching your stop loss because of spread or slippage. Now, if swing trading or day trading is what you want to do, then this is something you have to know and, make adjustments for. Because if you don't, then you're just going to be, you're going to be taking losses left, right, center, even without price actually hitting your stop losses. Okay. So you need to understand this and, plan your way to work around this issue if that's what you want to do. Okay. One way that traders tend to combat this is they tend to stay out of the markets when there's high economic news events, like red folder news economic events that are going to come out any moment. So, for example, to do that, you could do something like check a news website like Forex Factory. Okay, so if you check Forex Factory, for example, okay, let's quickly type Forex Factory. You could even do a Google search, okay, and then click on the first results. Then this site actually gives you all of the updates of the news that are due for the markets, depending on the day you're trading or the time or whatever the case might be. Okay, so in this case, you can see that today is the 21st, and so there is no news, there's no red folder event for this day. But let's assume that you don't want to just see the news for today, you want to see the news for this week. So you could just click on this week, apply the settings, and voila, you're going to see all of the news that are scheduled for this trade this week. Now, most of the times, the news that tends to cause the most movement in the market are these red folder events, because they are the high impact news. You see, high impact expected. What does this high impact expected means? It means that we're expecting, because this news is a very big news, we're expecting a high impact in the price of any currency pair related with the Canadian dollar, since this news is going to be coming out of Canada. And the USD, like this one, is also a red folder event, so it's a high impact news. But compare this to the yellow ones, these are the low impact news. Okay, and so if you wanted to just see when there's high impact news so that you could avoid trading currency pairs which are going to be affected, so that you don't get the negative effects of this widening of spreads and slippage and all of that, then you could use a calendar like this, and then you could also filter the news that you want to see. So since these ones are mostly all of the other folder events, the orange one and the yellow one are usually events that are low impact, and this one is the bank holidays and whatnot. You could just say, okay, let me see when the bank holidays are, because when there are bank holidays, this is going to show you when there's going to be, the market is almost going to be flat, because like I told you earlier on, if the people who are making the moves in the market are not in their seat, most of the times the price is not going to move that much, okay, during those sessions. And the other way to look at it is these high impact events, they are going to cause a lot of movement in the market. So you're mainly going to be interested in the red folder events and the let's say the ash folder events, okay, which are going to show you when there are bank holidays and all of that. So now that you've selected it, you just click on apply filter, and it's going to show you all of the news that you should be worried about depending on the currency pair you're trading. And so for the upcoming week, you can see that if you were to trade any currency pair which involves the Australian dollar, then you would want to pay extra attention, to either stay away from it, or any trades you have to manage it properly by maybe moving your stop losses to break even, or doing anything you're supposed to do to take care of that position properly. Because at around 2 a.m. in the morning, we are going to be expecting a speech from the governor of the Central Bank of Australia. And usually those type of speeches, they tend to cause strong movements in the price of a currency. And if you were to trade something like the Japanese yen, for example, on Tuesday, you can see that the Japanese yen, we've got a bank holiday. And so it's not going to be uncommon or unlikely that the Japanese yen is, maybe not going to move all that much on Tuesday, because, there's a bank holiday in Japan for whatever reason, okay? And so you should know that. And this is the way you'd actually want to incorporate, being aware of what you're trading and what is likely going to affect it and the way you trade it, okay? So this is one way you could do that. I even know of traders who completely stay out of the markets. I'm talking about scalpers and day traders, obviously, okay? Who completely stay out of the markets any day there's a major news event that is going to affect the currency pair they're trading. So, for example, like we have this GBP news, this flash manufacturing PMI, which is a high impact news. You can see not only that news is coming out, not only is that news going to be coming out at around 9:30 in the morning on Tuesday, but we also have flash services PMI, okay? And it's also expected to have a high impact in the market. So some traders who trade, for example, the GBP, and let's say they trade the GBP JPY, somebody might just say, we're expecting this high impact news, which is going to be affecting the British pound. And there's also bank holidays on Tuesday, okay, for Japan. So we're basically just going to stay away from the GBP JPY completely on this day. And then on Wednesday or Monday or any other day that, there's no news affecting this, they could trade it with whatever edge they've developed and tested and proven that it's working. And they'll just trade it normally because they know that they're likely not going to have an intervention from, any external market forces causing, unfavorable trading conditions due to high volatility or increased volatility, sudden increase in volatility in the market. Okay. So we want high volatility in the market because without volatility, price is not going to either move to hit our profit target or quickly hit our stop loss so that we get the trade over and done with. But sudden spikes in volatility, like, within a second or a minute, price moving 100 pips or whatever, it comes with the negative effects of widening of spreads, which could cause price to either hit your stop losses prematurely or make you lose much more than you wanted or you were planning to lose on a given trade because of slippage or widened spreads and all of those adverse effects, okay? So don't misunderstand it. It's not as if we don't want high volatility in the markets. No, we do want high volatility, but we want them in a controlled pace, okay? We don't just want sudden spikes in volatility, okay? I hope you get the difference. To show you an example, there's even a trading strategy that was developed based on this particular factor. So you remember when I told you that usually what tends to happen is that during the Asian session, there is usually there's less volatility in the markets because, the big sessions, the big boy sessions, which usually cause serious price movements in the market, are closed during those sessions. Sessions like the New York session or the London session, the European session, all of those sessions, okay? So what happens, the logic behind this strategy is that they're going to actually measure the price movements for sessions, for the Tokyo session. So you see, for example, this blue dotted line you're seeing is the price action which occurred during the Tokyo session. Okay. And so because usually the Tokyo session, there's much less volatility during those sessions, what tends to happen is that traders will wait for when the New York or London session begins and there's a breakout above or below the Tokyo session high or low, then they're going to take a trade because they're assuming that most of the movement which is going to occur during a given trading day is usually going to occur in sessions outside of the Tokyo session. So with this in mind, just look at this example, okay? So we have the Tokyo session here. This is the high of the Tokyo session. This is its low. And so when price broke above this high of the Tokyo session at the end of the Tokyo session, during the sessions other than that, then the way the strategy works is you're going to place a trade, take a long trade when price breaks above the Tokyo session's high, and then place a stop loss at the Tokyo session's low, aiming for a risk to reward ratio of 1:2. So if you're risking 1% of your account capital, you're going to be aiming to make 2%. So you can see that if you are taking this trade, price would have come just a couple of pips from hitting your profit target, but then eventually it reversed against you and it would have hit your stop loss way around here. But this was just a trade of one day. Okay. And remember, if you've been attending these classes, if there's one thing I keep telling you is the fact that you can never escape losses in trading. In fact, the strategies that I used to trade, most of the times I lose like 60% of the time, or a little above 55 or something percent of the time. But the 40% of the time that I win, or the 45%, because the profits I make from my winning trades are much larger than the losses I incur from my losing trades, I still end up being profitable. Okay. That's not a problem, okay? There's no trading strategy or trading system that's going to win 100% of the trades you take. So let's assume we lost this trade, even though we came very close to our profit target. And because we lost it, you didn't break your rules or started trading emotionally, revenge trading, and all of that. You just stuck to the plan. Risk 1%, follow the strategy's rules without breaking anything. And say the next day you took this trade, okay? While this one was open because it didn't hit your stop loss, you took this trade because this was the Asian sessions high and low. And so when price broke below the sessions low, you would have taken a short trade here with your stop loss at the sessions high and then aiming for a 1:2 risk to reward ratio. Again, you would have seen that you would have taken this trade here with a stop loss here, but price would have never hit your stop loss and it would have easily hit your profit target, which was somewhere around here at around the same time when it would have hit your stop loss for this particular trade. So this trade would have been -1. That's a loss of -1%, and this trade would have been a profit of +2%. So you would have paid for the loss you incurred from this trade with an extra. And then the trade after that, you would have taken this trade because this was the session's high, this was the session's low. And so you would have taken this trade after the breakout of the session's low, and then your stop loss would have been here, aiming for a 1:2 risk to reward ratio. Again, you would have seen that price would have hit your profit target right around here. So you would have made a profit of 3% with a loss of just like, a profit of 4% with a loss of -1%. So net profit of 3%. Again, you would have taken another trade somewhere around here. This was the session's high, this was the session's low, and it broke above the session's high. So you would have taken a buy trade here with a stop loss here and your profit target here. But this would have been a losing trade also. But remember, you made profits from this trade. So you would have been up +2% at the end of the day. You would have taken another trade here because this is the session's high. Asian session, remember, this is the session's low. This is where you would have taken the trade when the session's high was broken, with your stop loss being here, and price would have hit your profit target. So +2% plus another 2%, you would have been up 4%. So you just keep doing this, rinse and repeat. Okay? So this is capitalizing on the low volatility of the Asian session, and then it's coupling that with the high volatility of the sessions outside the Asian sessions, like the New York session and the London session, when we have a overlap in the market, okay? And then it's taking advantage of that, okay? So you can trade this strategy on whatever pair you want to trade, okay? But test it, and then prove it live that it works, and then, modify it to suit your needs and whatever the case might be, okay? This works, and this is the way this whole thing works, okay? So I hope this pretty much helps you see how to use this, and that's pretty much all there is to it. But before we wrap up the class, as is the norm in this ITU Forex classes, I would like to use this opportunity to inform you guys about the bots that we have, which are trading expert advisors that are meant and designed to trade on your behalf while you're out there doing other things with your time, okay? So they're able to find low risk, high probability trading opportunities for you, and then take those trades with proper risk management and help you earn while you're learning, okay? So if you're interested in taking advantage of these tools, please reach out to us in the comment section or on our socials or any of the channels you feel much more convenient reaching out to us on, and we'll be more than happy to assist you set everything step by step, okay? Once again, thank you very much for taking time out of your busy schedule to come to this class. I look forward to seeing you guys in next week's edition, and go out there and crush the markets, okay? Test the strategies out. Don't just come and just hear what we say without actually putting it into action. Test it out, practice it, and then, develop something that would help you to become a profitable trader, okay? Have a portion of your portfolio to automated trading, a portion to manual trading, and then eventually you're going to, start making money finally from trading, okay? So I hope this helps you, and I look forward to seeing you guys in next week's edition. Have a wonderful rest of your week, and God bless you, and cheers, okay?